Hi, I'm John King with Summit Funding, and today is Friday, the 29th of April, and I want to give you an update on what the heck is going on with the economy right now. We are going to continue, and we have been seeing a lot of strange things happening when it comes to inflation, when it comes to the Fed and what they're doing with interest rates, housing prices and what's happening with housing prices. And I'm going to talk about all of that today. So listen up, because I got some really good information that will help you, whether you're in the process of purchasing a home, refinancing a home. If you're a homeowner or a renter, you're going to want to know what's going on in the market. So I'm sending this out to everybody I know and asking them to share this with everybody they know, because this is really good information that is extremely timely. So the first thing I'll tell you is interest rates have continued to move up on mortgages. We're seeing mortgages for sure in the fives, depending upon the circumstances. We're as low as 5 to 5.25. In some cases, I've got clients that I've locked in at 5.75 to 6.1. So we've definitely seen a significant increase in interest rates over the last month, and there's no sign of that slowing down in the near future. I would have said, as a matter of fact, if you go back to some of my videos on YouTube from a few months ago, I was saying, hey, the highest I think we're going to hit is probably 4.75 to 5%. We've surpassed that by far. And again, there's no sign of it slowing down. Why, John? Why are interest rates not slowing down? It's simple. It's inflation. Inflation is making the cost of everything go up, because inflation is now becoming a bigger problem because of the fact of what's called wage inflation. So you have price inflation, which is just the cost of things are going up, and that happens because of high demand and low supply. And so when there's a lot of people trying to buy few goods, then the price goes up. That's basic economics, and that's created inflation. The problem now is wage inflation, because price inflation can go up and then come back down. We saw it in the price of lumber last year in 2021. We saw lumber prices skyrocket, and then we saw them come back down. That was a commodity that was in high demand that had low supply. Prices went up, and then when it balanced back out, prices came back down. Gas typically will do the same thing. We'll see gas prices skyrocket up, and then we'll see it come back down. But what happens is when inflation lasts a longer amount of time, and when you and I, as normal people, start being worried that, man, this inflation thing is here to stay, we start demanding more income from our employers. We start switching jobs and saying, hey, I'm going to go to work somewhere else for more money, even though I love what I'm doing and where I'm doing it, and I've made enough money to live and to do the things I want to do. With inflation, a lot of people are no longer making enough money, and so they start job hopping. They start demanding raises. Wage inflation doesn't go away as easily. If you job hop to a job that pays a higher wage, that employer is now paying you that higher wage long term. And that means that prices are going to have to rise permanently, because wages don't come down easily. So inflation is becoming a bigger and bigger issue. And the longer inflation goes uncontrolled, the deeper this problem becomes. So the Fed has to act. That's the next part of what's happening. Next week, May 3rd and 4th, so may the 4th be with you and may the 4th be with the Fed, because the Fed is announcing on May the 4th their next steps on how they're going to fight inflation. Back at the middle of March, by the way, the Fed meets every 6 weeks. So every month and a half they get together, they start their meeting on a Tuesday, they finish it on a Wednesday, and they make their announcement at 11 o'clock Pacific time is their announcement. Sometimes they have a conference call that happens, or a press conference that happens at 11:30. So that's happening next week on May the 4th. We expect them to raise interest rates for sure. We just don't know how much. Back in March, they raised interest rates by 0.25%. There's a lot of talk that they're going to raise interest rates by 0.5%. Some people are guessing the Fed's going to raise it by 0.75 to 1%. Don't misunderstand. The Fed does not control mortgage rates. So if the Fed says they're raising rates by 1%, that doesn't mean mortgage rates are going to go from 5.5 to 6.5. As a matter of fact, the bigger the Fed raises the prime rate, the more it will curb inflation, because it will stop all the spending. Because all these companies are spending money right now because money is cheap and easy, and they want to slow down the economy to slow down inflation. So a big increase in interest rates is good news for the mortgage market, because we expect that means that inflation will start slowing down. Inflation's what's been driving mortgage rates up, and we expect mortgage rates to start coming back down, or at least stop going up, once we know that inflation is under control. We got, we got inflation numbers yesterday, and it showed inflation is still out of control. Not as out of control as it was, but it's still out of control. We're seeing a 5-point-something% increase in the price of goods year over year. It was 6-something last month, and so it's not as bad. It's still really bad. The Fed's target is 2% inflation, and it's been almost zero for the last 10 years. Like basically no inflation. They want it to be 2%, and now it's been 5, 6, 7% inflation every single year, over last year, I should say. So what does that mean? It means you've got to worry about what is happening with your home equity line of credit, what is happening with your credit cards, because those interest rates are about to go up significantly. They already went up in March by 0.25% because most credit cards are variable interest rates tied to prime. The prime rate moves right along with the Fed discount rate. So we're going to see a significant increase in your home equity line of credit interest rates, your home equity line of credit payment, in your credit card interest rates, and in your credit card payments. That is an opportunity right now for people to get ahead of the curve. I have multiple clients right now that I'm looking at refinancing, paying off a 3.5% interest rate on their primary mortgage because they have a bunch of credit cards. And even if they're going from 3.5% to 6%, they're paying off 25% interest rate credit cards. And they might owe $200,000, $250,000 on their mortgage, but they owe $50,000 or $60,000 on their credit cards. And there's a formula I run called your blended rates. And that simply says, hey, I owe this much money at this interest rate and this much money at this interest rate. What's the weighted average of that money? And that's how we compare. But remember, your credit card rates are going to continue to go up. And that's what we have to fight against. So if you know somebody, or if you yourself are in a position where you've got a sizable amount of debt through credit cards, through home equity lines of credit, now would be the time for us to consider consolidating that and putting it into a new mortgage, because then in the next year or two, it's wholly expected we're going to hit a recession. A recession causes interest rates traditionally to go down. So the Fed is going to raise their rate. That's going to cause inflation to hopefully curb and stop, but the Fed raising rates will cause a negative effect of a recession, and recession is going to lower mortgage rates. The good news is if you consolidate your debt now, you actually pay a little extra in fee when you're consolidating debt compared to if you're just refinancing what you owe. Well, you're better off paying that little bit extra right now, and that way you get the best deal in a couple of years when it's time to refinance to get a lower interest rate for the long term. The final thing that I want to talk about is housing prices. We have seen housing prices crazy for the last 2 years. And right now we're in a position where we're starting to see some cracks in the dam. And I'm seeing really strong anecdotal evidence, and it's going to be case by case, market by market. I'm jokingly, there's an analogy that a local real estate appraiser gave that says the housing market right now is turning out to look like a Hot Pocket that was taken out of the microwave too early. Well, if you've ever taken a Hot Pocket out of the microwave too early, you realize there's some super cold little spots and there's some super hot spots. And that's what we're dealing with. We're dealing with a changing market. I don't see a crash happening. We still have a huge amount of demand. And we have a lot of buyers who have been waiting on the sidelines. Those buyers have been frustrated because every time I go to buy a house, there's 14 other people trying to buy the house, and I just can't deal with the emotional roller coaster. Now, granted, interest rates are higher and some people can't qualify, but there's a bunch of people who can qualify that just didn't want to have to compete. Imagine if you were going out and trying to buy a new car, and every weekend you went out and looked at a new car and you test drove the car and you said, okay, I love it. Can I have it? I'm sorry, you have to line up with these 14 other people for an auction to figure out which one of you gets it. And then if you don't get it because you're one of the unlucky 13, then you got to come back next weekend and try it again on a different car because we're not going to sell this model anymore. You have to fall in love with that model car. You have to fall in love with that home. And then you have to find out I'm not going to actually get the home. And now you got to start all over again and fall in love with something else. And so many people can't deal with the emotional roller coaster, so they've gotten out of the house hunting. But as soon as this market starts to show less demand and less offers, more people are putting their houses on the market. We're seeing some more price reductions that we haven't seen. We're seeing homes that are staying on the market longer. So those buyers are going to come back in. And if you're one of those buyers that was sitting on the sidelines saying, I can't take the emotional roller coaster, it's time for you to call me back. Let's talk about getting you qualified now, because I think you're going to find a little bit easier opportunity. Yes, it's going to be more expensive, but you'll have the opportunity to refinance in a few years when interest rates drop back down. So take advantage of the opportunity that is presented right now. And if you are a seller and you're looking at selling soon, get your house on the market now and do not have unrealistic demands or expectations. The market that we were in 2 or 3 months ago is not the market we're in today. If you have a solid offer, take it. Don't wait for 3 more. Don't try and be in a position where, hey, I'm going to leverage this and I'm going to ask for 100,000 more than what my neighbor got it for, because I can't predict the future, but I feel like the market is shifting under our feet literally as we speak. So the homes that are closing escrow right now had high demand. The houses that are going into listings and on the market right now, I heard last weekend, there were a lot of houses that had open houses that had very, very few people coming through. There were other neighborhoods that were jam-packed with buyers. So just be aware the market is shifting. Don't get caught trying to catch a falling knife if you're in a position where you overprice the home and now you keep trying to drop it, because buyers are starting to really kind of be fickle, and they're starting to say, well, wait a second, why didn't this house sell yet? What's wrong with this house if it hasn't sold yet? Well, buyers, you got to think about this. You're in a position where you couldn't get an offer accepted on anything if you tried. Now that you can, don't look at it as a negative, look at it as a fact of opportunity, and let's take advantage of that opportunity. Hopefully this helps, guys. If you have any questions about anything at all, give me a holler. Please like this, share this video on social media, share it on YouTube, share it on other social media platforms. I know it was a long one, but I hope it was helpful. Have an amazing weekend, and we'll talk to you soon. Bye-bye.